Hello and welcome to the special broadcast on Bloomberg Quint. We're here to cover the RBI's monetary policy, or should I say the Monetary Policy Committee's announcement this afternoon, and we're just minutes away from it, 15 minutes to be precise. I'm Menaka Doshi, of course, with me is Neeraj Shah. We have in studio with us Anand Bagri. He's Executive Vice President and Head of Domestic Markets Treasury at RBL Bank. And I understand that we're also being joined right now by the CFO of SBI, Anshula, is with us. At this point, Shubda will be with us in just a few minutes from now. Good afternoon to all of you. I'm going to start by putting a question first to you, Anshula Kant, Deputy Managing Director and CFO, joining us this afternoon. Anshula, what do you make of how we're going into the policy? The equity markets are going in with about a 1.5% gains. The bond market right now below 7.3 and the rupee stable at about 65. Are you expecting a dovish tone in the policy?
Good afternoon. I'm expecting a neutral tone actually from the policy. I think the one other good thing we could expect is the increase in the FPI limit, maybe by about 1%. That would, be very positive going forward.
All right, let's put that question here in studio to Anand as well. Anand, 7.3 you think is the floor for this?
I think before speaking on the GSEC yields, let me just take you through the what we expect in the policy. I think some of the factors which persisted in the Feb policy, I think the policymakers would take cognizance of that. For example, in terms of inflation, nothing much has changed. In fact, there could be risks on the upside with reference to the higher MSP prices or the crude oil and commodity prices, which have moved much above the comfort zone. And I think if you look at the fiscal slippage, even though there has been a technical correction in terms of lower supply in the first half of the present financial year, I think it's been around 52% is the supply in the first half, which is usually is around 60 to 65%. The calendar is generally front loaded in the first half of the year. So markets were expecting some front loading there, which didn't turn out, and so there was a little bit of technical correction. So in terms of yields, possibly we have seen that there has been a technical correction, but in terms of the policy, I think there could be some risks to the upside, which the committee makers might, which the policy makers with the committee might would like to highlight in the forthcoming policy.
All right, so let's see if Shubda agrees with you on that risk to the upside when it comes to inflation. Shubda, it's a little confusing for a layperson like me. Are we talking about more benign inflation through the course of the year, because that's what some economists and analysts expect, or are we talking about potential upside risks to the inflation numbers that the RBI put out in February?
Yeah, thanks, Menka. I think, the current trajectory seems to suggest that the peaking of inflation in sometime expected in June may not really exceed 5.5%, which to my mind is not such an alarming number, because subsequently you are going to see in the second half of the fiscal year a fair amount of deceleration in headline prints. Now, quite clearly, what are the risks that we are talking about here are a direct impact of the minimum support price revision, which will be announced in June. That will potentially have, in the current year, second half of the fiscal year, about 25 to 30 basis point headline impact. That impact is equal amount will be spilling over into the next fiscal year first half. So MSP impact is not going to come entirely in the current fiscal year. That is one thing we need to take cognizance of. The second is, as it was being alluded to earlier, the crude oil prices, in our opinion, RBI was somewhere working with the math of $55, $56 to a barrel. Currently averaging is now around 65. So that upside risk of crude should be, getting embedded into the inflation trajectory going forward. The last is, of course, importantly is, perhaps government may, in this election intense year, front load some of its expenditure, which would boost demand and therefore add to inflation. So for a layman, what is the trajectory that we look at, and therefore the risk on interest rate cycle? I think inflation is likely to peak in June, but much lower than what was earlier getting anticipated. And that's purely because in the recent inflation prints have come in much lower than market consensus. We have seen a fair amount of disinflation, deflation in some of the perishable items, which has taken the print quite low. In fact, the incoming print a week later, we anticipate is going to be a tad below 4%. That implies that the peaking may not be above 5.5% if all of the factors that we talked about do get embedded in the trajectory. Our opinion is that, the interest rate cycle probably is going to see one more rate hike sometime in the June or August review. But thereafter, a lot of global market developments, global central bank actions will be watched out for, in addition to any domestic risk like a monsoon. If monsoon fails, there are huge price pressures on perishables. We could see overall inflation print getting much higher than the comfort. So a lot of moving parts, Menika, at this juncture, but currently I think more than the rate action, which we believe will not be in sight today, I think the tone and the, I don't think it's going to be ultra dovish because potentially the risks are on the upside, but not enough to warrant for the markets to quickly, anticipate many hikes. Probably one rate hike, and our expectation is, we need to thereafter watch out more on the moving parts, trade war, or whatever other factors that come in. Incidentally, housing rate inflation impact is going to be waning. So that is actually a cushion, because over the last 2 months, we have seen a reset of housing prices done by CSO, and that is actually going below the housing inflation that most of us had anticipated. That is going to be one positive factor to subdue some of the inflation pressures coming out of housing. So in nutshell, more than action, which is not expected, the tone is more going to be watched out for. How does RBI perceive all these elements moving forward, whether that prompts RBI to move its trajectory, taking it as a base case scenario, or put it as a peripheral item. Perhaps positively that RBI could talk of is the pruning of the government borrowing from the markets. But as I said, early days yet to give a complete, confident, 100% probability pronouncement from the Reserve Bank of India.
So let me just find out from Anshula then on what she's hoping to read when she sees that Monetary Policy Committee statement in a few minutes from now. Anshula, what will you be watching out for in terms of language? The last time round, I think the sentence which referred to wanting to encourage or protect the nascent recovery in the economy is what lent everybody to believe that this is a slightly dovish stance of the RBI. What language are you looking forward to this afternoon, or expecting rather?
Actually, I wouldn't like to comment on the possible or potential language they may use, but definitely we are looking at a neutral liquidity stance. It's only very recently, in the last 1 week or so, that things have eased a little, and today we are marginally surplus. But given the redemptions that are coming up and some government spending to start, we do expect that liquidity to ease. And definitely some of the steps that have been taken by RBI in the very recent times in terms of allowing banks to spread the MTM losses across 4 quarters, some easing on the NCLT accounts provisioning, temporary though, does augur well for what we may hear today. And I think going forward, yields should come off, I think, further by another 10 to 15 basis points. That is our expectation. But like the other panelists have said, I too don't expect the stance to be very dovish. It should be neutral, but our internal house view is that the pause will be of a longer duration. We are not really expecting even a 25 basis point hike in this financial year. We expect it to be status quo more or less.
Okay. Anand, just a quick question. One is the RBI move for the mark-to-market losses. The government borrowing cut already has helped yields come off considerably. Yeah. What can happen in the policy today for that trajectory to sustain?
Possibly if the market players think that the policy has been slightly dovish, then possibly the yields could continue the downward slide. Possibly it could touch all the way down to around 720 levels. We would also need to see how the voting pattern is. If people, there was one person who had voted for a rate hike last time. I think if people are expecting that there's an unanimous decision to keep the rates at status quo levels this year, that would be considered as slightly dovish. Or possibly if one of the policy makers decides to vote for a reduction in rates, that would be considered very bullish for the markets. But in all these scenarios, I don't think the yield should go below 7.10 levels as we see.
Okay, Mr. D.K. Joshi, Chief Economist at CRISIL, also joining us on the show. Mr. Joshi, thanks so much for joining in. What's your base case estimate? Almost everybody is going with the presumption that it's a pause. In all likelihood, the language will not be hawkish if it's not dovish. And the impact on yields, a considerable impact already been seen, maybe a small bit of further slide down from the current levels. What's your base case estimate?
Well, I think I expect the central bank to stay neutral, but they will definitely flag inflation risks, which they flagged last time also. And I think the three risks that have already been pointed out. One was the minimum support price, on which last time they said the clarity is awaited as to how it is going to be implemented. And the status quo continues. I mean, we still don't have much clarity on how much intensely will it be implemented. As far as oil is concerned, oil has risen from the last time. I mean, it's gone up by about from December. I think it's gone up by $3 to $4 a barrel. And the third risk, I think, is on the fiscal front, which is which the bond markets were also pricing in earlier. And I think with the announcement from the government that they're trimming the first half borrowing program, I think that the markets read less risk to on the fiscal side. But I think all these three risks, I think central bank is going to continue to reiterate in this policy. And I think we expect the bond yields to stay where they are. I mean, it's going to depend on what kind of language they use and what kind of forward guidance in the sense of tone, I think they give. But my broad sense is that the caution on inflation front will prevail. And inflation has surprised on the downside until now. And but going ahead, I think there are some risks which are clearly emerging. I mean, and even I think on the import front, I think the currency is likely to weaken this year. And on top of that, we are also putting in some import tariffs. So I think the imports will also become expensive. So there are some pressure points on the inflation front emerging, and a lot will depend on how. I think the prime driver of inflation, in my view, would be the food inflation, because the reason why inflation is low right now is largely because of food. And I think if food inflation turns around, I think that could be a source of worry.
Mr. Joshi, we have only about 3 minutes to go before we do actually get the announcement from the MPC. A very quick answer or response on your growth outlook. I know everybody's working with around that 7%, 7.2% figure. Are you convinced that's where we are? Do you think we might in fact surprise on the upside with growth? Because a lot of our conversation so far has been focused on inflation, but we are all seeing green shoots of recovery in the economy, aren't we?
Yeah, there are. I mean, obviously, I mean, there is some pickup in the economy which is visible. And I think on top of that, we also have a very low base effect of last year. So our expectation is a little bullish, and we expect GDP growth, not the GVA, which the central bank forecast, GDP growth to be 7.5% this year. And this, I just want to make a point that this is not only over a weak base, but it also trails the average of last 15 years, which is a little over 7.6%. So clearly, I think this, even at 7.5%, it would be some sort of an underperformance from a trend perspective.
Anshula, can we get a quick response from you on whether, I don't think we're seeing this in credit offtake in any substantial fashion, are we? So from the, bank point of view, are you seeing, do you have enough conviction in this recovery that you're seeing in the economy?
I think the recovery continues from the household sector. The credit demand is coming largely from there, and personal segment, housing, commercial vehicles, etc. On the corporate side, I think recovery is still very slow, and even in the next year, we don't expect numbers to be very, very strong next year either.
And so that will continue to be a weighing factor, if anything at all, on the RBI, or will the RBI sort of expect that to work out of the system only 1 or 2 or 3 years down the line, given where we are in terms of capacity utilization, etc., etc.?
I think it will be a slow improvement, and given the fact that beginning this quarter itself, we will see some good resolutions going through under NCLT. The very fact that the haircuts will have to be written off from the top line, that itself will pull down the, the credit outstanding numbers. So I do believe that it will be a slow improvement, and RBI will look for a calibrated improvement. I don't think anybody is looking for a really V-shaped kind of an improvement.
Okay. You want to put in a quick question to Anand on this FII limit if it's raised?
Yeah, so by the way, the policy announcement should be out 14:30 already. So just wait. Okay,
unchanged.
I think told unchanged.
All right, yeah, there it is. So now we'll wait for the language and see what that says. But before that, I think we were also expecting some sort of FII limit reversal, right? Increase, rather.
The expectations are already there in the market. I think 1% is already discounted in the market. If the hike is more than 1%, then possibly there could be a positive surprise. But having said that, I think at these levels, at levels of around 7.10, we need to see how much the actual FPI, the FI investors come at these levels, because even the US yields, dollar yields being at 2.75, 3%, it might not make much sense to invest at around these levels. So we'll have to see how the thing pans out.
Okay, just pull up the bond yields. No big reaction thereof, by the way, 7.2790. So there is hardly any movement that's happened. Naturally so, the RBI has maintained status quo. We'll still wait for IRA to come in and give us any sense of the language, and probably wait for the press release as well to come in. I think watch out for these numbers on the reversal of, or rather the upping of the caps on the FI investment into bonds. So that is one key thing for bond yields. The equity markets too haven't really moved. In fact, the Nifty Bank, if anything, has surged. Actually, if I can bring the intraday of the Nifty Bank, it's actually shown a bit of an uptick, 1.7%, 1.83% now for the Nifty Bank. So banks have taken this very, very well. I don't know why. The Nifty to 1.67% higher. So the markets are doing very well. In fact, the yield, has really come off, 7.24. I don't know if this has got to do with some change of the cap, because otherwise the policy rates are unchanged.
The RBI, the statement seems slightly dovish. I think they have reduced the CPI projection. I think we'll have to just wait and watch.
Look at the 10-year bond yield. That's really come off, and come off very, very sharply. Mr. Joshi, your initial thoughts? If indeed the policy statement is dovish, we'll wait for IRA to come in. But if indeed that is the case, because there is no change in the policy stance, but the yields have come off, and come off considerably.
Well, I think I'll have to read through the text, before commenting on that. But clearly, I think if they have lowered the inflation outlook, that itself is a positive news for the yields, and maybe yields are reacting to that.
All right, we have some flashes coming in which says RBI sees inflation at 4.4% for the second half of FY19. That, I think, is a minor change, I think, from the 4.5 to 4.7% band that they had mentioned in February. So I don't know if that's what's influencing the bond market at this point in time. They've also said that their position remains neutral. Shabda, a quick response on how you'd read into that at this point.
I think that's a sizable cut in inflation forecast from 5.76.1 to about 4.75.1. I think that's from 5.1 to 5.6 to 4.7 to 5.1. That's a sizable cut in inflation forecast. And that is, mind you, the peak time, that is the first half of fiscal 19. In June it peaks, remember that. So the subsequent trajectory is going to be definitely lower. That probably is being read in the market as a very limited case for rate hikes going forward. If the central tendency of inflation is moving closer to 4.5, I don't think there would be very strong enough rationale for the Reserve Bank to go ahead and effect a rate hike, which, including us, we were expecting one rate hike from the earlier two. But with this kind of inflation revision downward by a substantive 50 basis points, the sense I get is the case for rate hikes gets subdued. Of course, we need to read further into what the perception is. But at this quick take, I think that's the reading I would take from the Reserve Bank of India statement.
Minka, Dr. Michael Patra did vote for an increase in the policy rate at 25 basis points. So that's...
Some things stay constant.
Some things have stayed constant indeed. Ms. Kant, sorry.
No, go ahead.
Ms. Kant, your initial thoughts. There is the pullback in the inflation expectations for sure, though in point number 20, the MPC is saying that there are several uncertainties, as I believe they would say, surrounding the baseline inflation path as well. Actually, Anand, if I can bring you in this conversation, because the inflation targeting probably seems to be the only reason why the yields have reacted the way they have.
In fact, as I see, there are 2 out of 6 members who voted for a rate hike, as we see. Only Michael Patra has voted for an increase in the policy.
Dr. Ghate, Pamidua, Ravindra Dholakya, Vidalacharya and Urjit Patel voted in favor of the monetary policy decision.
This is more or less status quo only. So I think possibly yields we could see another 5 to 7 basis points decrement in yields, but I think that should be the base for base as of now.
Okay, Dr. Joshi, we don't have any other. We're trying to get more details. I'm sure in moments from now, Ida will come in. Their conversation around inflation seems to be a lot more measured than what was earlier.
I think, the economic outlook, Mr. Joshi, is something that you might want to comment on. This is the operative part. In this unsettling global environment, the RBI says, or the MPC says, it is especially important that domestic macroeconomic fundamentals are strengthened, deleveraging of distressed corporates and rebuilding of bank balance sheets persisted with, and the risk-sharing markets deepen. That's all it pretty much has to say with regards to the economic outlook after having sort of listed out both the upside and the downside views. So I don't think its outlook on the economy stands very changed from the last time, except that we don't see any language here with regards to a nascent economic recovery of any sort.
I think from what you just said, what I would read off it is that it's very critical at this juncture to ensure that the fiscal prudence continues and we remain somewhat insulated from global financial turmoil by improving our macros or by maintaining our macros at a healthy level. But I think I just want to bring out a point here that we've been saying that the RBI is on a neutral stance for some time, but I think I want to highlight that the de facto interest rates in the economy have actually gone up over the last couple of months, whether it is the GSEC yields or it is the corporate bond yields or it is the banks. I think 6 or 7 banks have raised MCLR over the last few months. So there's a de facto tightening happening in the system, which will slow down or maybe reverse a little bit.
Okay. Anshula, what do you make of this afternoon's announcement, status quo on rates, a marginal downward view on inflation, and from some of the other headlines, I understand the RBI has also announced today that they've deferred the implementation of Ind AS accounting standards, which should add to the good news that the banking system has witnessed over the last several weeks. There are some comments coming in on virtual currencies and digital currencies, but for this point in time, I'll stick to these things and the growth outlook to get your view. Anshula? All right. Okay. I think we've lost that line with her at this point in time. We'll put that to Shubhda as well. But, it's not, of course, a question from a bank point of view, Shubhda. Shubhda, besides the economic outlook, which stays almost the same, this marginal downward revision in the inflation outlook is the only moving point in this policy. And as you've said, this rules out the case for any uptick in rates at all from here onwards, right?
Yes, I think, increasingly as I read the statement in a more detailed fashion, I think the lowering of inflation forecast both for the first half and average of second half at 4.1, 4.4, though risks have been flagged on the upside. But I think given this kind of inflation trajectory, a rate hike at any given point in time is going to be, will need very solid justification of significant movement in upside risk, which at this point from the current commentary does not appear to be so. So my sense is that we will get back to our drawing table and once again look at our numbers in terms of inflation risk. Given this kind of commentary, even the next 25 basis point rate hike looks to be a little bit of a question mark in my opinion at this point. So probably we are going into a prolonged pause a status quo unless the data proves otherwise in terms of a steeper upside revision on RBI's own inflation projections, which we believe at this juncture unlikely to happen. So I think the message is more positive from the market's perspective, from the economy. Growth, they have anticipated a fair amount of traction in growth, the support coming in. So I don't think they are worried about growth momentum, and they seem less worried in terms of intensity of commentary as far as inflation risks are concerned.
Okay, I think we do have Anshula Kant back with us, so let me repeat my question to her. Anshula, I think there's a bunch of good news that's come in. One is that there has been a deferment in the Ind AS accounting standard as well for banks by 1 year. I'm sure you'll welcome that with all the other generosity that RBI has shown over the last several days. What do you make of, A, the inflation stance, the growth stance, and some of these relaxations in total?
In fact, you know, even in my earlier remarks, I had said that our house view was that inflation will be more benign than the market was expecting. That's got validated, and I'd also said that we are looking for a longer pause. We are not expecting a hike at all in this financial year. So I think this has got validated by the RBI commentary. And the other thing, you know, particularly I want to put on record about the Ind AS that you mentioned. Actually, we were not very keen for a postponement. We had been hoping and expecting that 1st April would continue as the date for cutover to Ind AS. We were very much prepared for that, but nevertheless, I think it will be, we are fully geared up for the next year for that. The other, you know, enablers that RBI has given in terms of spreading the MTM losses, those were really welcome. And I'm glad that RBI is on the same page in terms of inflation expectations this time as us. Growth, like I said, I think again this is as per expected lines, and we are actually fairly happy with these you know, comments which have been coming out from RBI. It will be very good for the bond yields. Already we are seeing that they have started to come off. At least that will be a big upside for the banks going forward.
Okay, I do want to ask you one more question, Anshula, not specifically related to this afternoon's announcements, but this morning's news, and that is the easing of provisioning on NCLT accounts. Could you just elaborate for us what the specific impact will be on SBI, or if not on one specific bank, the entire banking sector?
Actually, see, the earlier guidelines were said that you have to put 50% of secured portion and 100% of unsecured portion of accounts which were filed under NCLT as per the earlier dispensation of list 1 and list 2. That, I think this circular basically says that you can now go up to June to take it up to 50%, or if you have 50%, you can bring it down to 40% in March based on the expected recovery in these accounts. So that is one of the caveats that has been mentioned in that circular. It is not across the board. So if a bank is expecting haircuts of less than 60%, then you can sort of bring, if you know, keep provisions for secured portion up to 40%. But come 30th June, you still have to take them back up to 50%. So I think it will be a very temporary relief. The good thing is that some of the larger steel accounts, if they it's a small window, but the fact is it is very, you know, on the dot, in the sense that if some of these large steel accounts go through, and where we are expecting haircuts to be lower than 60%, definitely, in that case we will get some relief, you know, which you could have in any case written back that provision after the resolution happens. You could do it based on your expectation now to the extent of 10% of the secured portion.
Okay, but we haven't yet, Anshula, reached resolution on any of those large accounts. And, you know, I think there seem to be so many moving parts in each of those cases. So do you think banks like yours will have confidence to take that 10% reduction in provisioning at this point in time, or would you just rather wait out for the resolution to see how things go and then maybe write back, you know, whatever the sort of the less write-off is?
I think, you know, we'll be very, very careful while we use this provision, and we will do it in consultation with our corporate teams and with our auditors, of course. And it will be based on expected recovery, where we are fairly confident. So we are still to take a call on this. it will be very judiciously taken.
Do you all, and this is a question to all of you guests, do you, based on what the RBI said just about 2 months ago in February, where they termed this a nascent recovery, now they sound more sanguine about the recovery. They've moved, you know, sort of the inflation band lower as well. Do you believe there are enough reasons on ground, and I'll start with you, Mr. Joshi, do you believe there are enough reasons on ground for the RBI to have changed its stance? Or do you think that this is an RBI that's helping create a more favorable set of circumstances in the bond market for the government to come back to borrow, you know, later on this month? Let's start with you, sir.
Well, I think this stance was warranted, and I think everybody was expecting that. But I also want to bring in another thing. I mean, it seems that RBI has shifted to forecasting GDP. I mean, in the earlier releases, it was GVA. This time, they have explicitly stated 7.4% growth, GDP growth in 2018-19. That's a new thing, I think, which has happened in this policy. And I think the other interesting thing is that the upping up of growth target and lowering of inflation means that growth inflation mix is expected to improve in 2018-19. So which is again a positive for the economy. But I think central bank is cautious on the inflation front. So I think they would rather err on the side of caution, I would say. So they will play it cautiously and I think maintain the neutral stance.
Okay.
And keep their keep focus on.
Yeah, I think we're going to have to toss across to the governor. Urjit Patel speaking now.
Post-monetary policy press conference of the new fiscal year. Over the past 2 days, the Monetary Policy Committee reviewed evolving global and domestic macroeconomic conditions and decided to hold the policy repo rate at 6% while continuing with the neutral stance of monetary policy. In doing so, the MPC reiterated its commitment to keep inflation at the target of 4% in the medium term and to remain vigilant on how actual inflation unfolds. In other words, we continue to be data dependent. The MPC noted that while global economic activity and trade have gathered momentum and span, financial market volatility and potential trade wars pose a threat to the outlook. Moreover, crude oil prices have become volatile in the recent period. Considerable uncertainty persists about the pace of normalization, although not the direction, of monetary policy by systemic central banks. On the domestic economy, the MPC's assessment was that while GDP growth in 2017-18 of 6.6% was lower than a year ago, which was 7.1%, there were important intra-year turning points. Most notably, investment demand accelerated in the second half of 2017-18, and recent high-frequency indicators point to some further strengthening, with capital goods production registering a 19-month high growth in January of this year. On the supply side, both food grains and horticulture are estimated to have crossed new records. Industrial activity has rebounded and become broad-based, while the services sector has shown resilience and expanded through most of the year. However, with imports outpacing exports, the trade deficit widened in January and February. CPI inflation has eased to 4.4% in February, and excluding the estimated impact of increase or adjustment in the house rent allowances for central government employees under the 7th Central Pay Commission, it is estimated at an even lower 4.1%. However, with household inflation expectations having aged up and manufacturing firms reporting input price pressures and increase in selling prices, the committee focused on risks to the outlook for inflation. International crude oil prices have become volatile, with a distinct hardening bias from the second half of March. Moreover, aggregate demand is expected to strengthen during the course of 2018-19. A normal monsoon and effective food supply management by the government was seen as mitigating factors. Overall, the MPC assessed the risks to inflation as tilted to the upside. On the growth outlook, the MPC was of the view that the pace of economic activity could accelerate in 2018-19 on clearer signs of revival in investment activity and sustained improvement in global demand. On the flip side, external demand could be adversely impacted should crude oil prices persist at elevated levels or even increase, and trade protectionism intensify. On balance, we decided to remain watchful about the unfolding of these risks, as well as the impact on inflation of forthcoming revisions in the MSP, second-round effects of HRA increases by various state governments, and fiscal slippages. The committee was also cognizant of the implications for food inflation should the monsoon turn deficient temporarily and/or specially, and the uncertainty imparted to the outlook by the recent volatility in crude prices. The committee observed that growth has been recovering in an environment characterized by a pickup in credit offtake and large mobilization of resources from the primary capital market, which should support investment activity going forward. In its judgment, India's long-term growth potential is expected to be reinforced by various structural reforms that have taken place. Given the unsettled global environment, however, the MPC emphasized the importance of strengthening domestic macroeconomic fundamentals, persevering with deleveraging of distressed corporate sectors, rebuilding of bank balance sheets, and the deepening of risk-sharing markets. I now request DG Acharya to comment.
Thank you, Governor. Good afternoon, everyone. I thought I'll talk first about liquidity conditions and then about some market development measures. The surplus liquidity in the system, which had built up subsequent to demonetization and FX inflows until August 2017, the surplus liquidity continued to decline over the last 6 months with corresponding rise in currency in circulation in the economy. RBI has been using multiple tools, primarily reverse repos and open market operation or OMO sales, to absorb the surplus liquidity so as to reach the stated policy objective of neutral system liquidity. Since December, post the quarterly tax outflows to the government, the system liquidity has been almost neutral and has moved between deficit and surplus modes along with the changes in government balances. Towards the fiscal year end, and this is quite typical, system liquidity temporarily moved into deficit. The net liquidity injection by RBI to deal with this through short-term repo contracts stood by March end at rupees 0.58 trillion or 58,000 crores. The weighted average call rate or WACR has remained lower than the policy rate in the last 6 months on average, though the normalization of liquidity conditions has meant that this gap is actually steadily closing. Overall, the system liquidity is expected to be in a moderate surplus mode in the first half of fiscal year 2018, and the evolving liquidity conditions will determine our choice of instruments for transient and durable liquidity management. Let me turn quickly to a few market development measures that have been announced in Part B of today's resolution. I'll only talk about 3 of them. First, extending access to rupee interest rate swap market for non-residents with the intention of enabling better risk management by entities, particularly our banks. This proposal aims to tap into the active offshore rupee interest rate swap market to add depth and liquidity to the domestic interest rate swap market. This access will be subject to macroprudential risk limits. Second, introducing swaptions in order to allow better timing of interest rate management using interest rate swaps for banks and corporates, among other entities. This should help kickstart activity in interest rate options, which were introduced in December 2016. And third, reviewing and adopting of measures to breathe new life into strips, which were introduced in GSEC markets in 2006. This is in order to exploit the full potential that strips can provide in terms of targeted investments at specific durations, especially for long-term investors and financial institutions. Thank you.
Request DG Vishwanathan.
Thank you, Governor. I just want to highlight two important announcements that we're making on the banking regulation front. On the mandatory loan component in working capital facilities, the working capital requirements of borrowing entities are met by banks through a cash credit limit, which is a revolving facility. The cash credit facility places undue burden on the banks in managing their liquidity requirements, with corresponding repercussions for RBI security operations. Currently, banks do not charge any commitment fee and do not maintain any capital on the undrawn portion of the cash credit, because it is classified as an unconditionally cancelable facility, which does not have any risk weight under the Basel rules. So all these actually attenuate the problem. We therefore want to control the possible volatility in the utilization of cash credit limits by making it mandatory to have a working capital demand loan portion in the working capital facility. So we'll come out with a draft circular covering all these aspects for comments, and then we'll go forward on this. The second part is something that we've been asking every time on INDAS. So we have formally said that INDAS was to be implemented effective from this year. As a part of this, we have also been requiring banks to submit half-yearly returns based on the INDAS formats. The format of the financial statement as prescribed in Schedule 3 of Banking Regulation Act is not amenable to reporting financial statements under INDAS, and therefore we have requested the government to amend the schedule, and that's under consideration. In our assessment, also many of the banks are still not prepared to move into INDAS, so we thought that we should defer this by 1 year, and by when the preparedness and amendments to the schedule will also take place. Nevertheless, we'll continue to have the pro forma statements coming to us to kind of monitor how the banks are going forward on implementation of this. Thank you.
Mr. Kanungo.
Thank you, Governor. I wish to highlight three important announcements in the Part B, that is the statement on developmental and regulatory policies. The first pertains to the storage of payment system data. Payment ecosystem, as you would have observed, has expanded manifold. It has undergone rapid expansion in recent times. There have been new systems and new players, new platforms. The existing platforms and the systems, they have added new players also. To sustain this pace of growth, public confidence is the key, public confidence in the payment system. Therefore, it is necessary that safety and security of the payment system is robust, continuously upgraded, and is the best in class as per the international standard. The supervisory oversight to ensure that there is thorough monitoring and the surveillance is also crucial in this regard. It is observed that so far as the payment system is concerned, the players, some of them they store their data in India, some of them they don't store their data in India, some do it partially. In order to facilitate this continuous surveillance and monitoring, we are mandating that all the payment system operators, they will be required to keep their data inside the country, and this will be done, must be achieved in a period of say 6 months. So this is the first important announcement. Regarding ring fencing the regulated entities from the virtual currencies, digital tokens issued by the private parties are getting international attention for quite some time for their speculative value. Internationally, while the regulatory responses to these tokens are not uniform, it is universally felt that they can seriously undermine the AML and FATF framework, adversely impact market integrity and capital controls, and if they grow beyond a critical size, they can endanger financial stability as well. In the past, RBI had reportedly cautioned on, at least I remember on 3 occasions, the members of public, the users, holders and the traders in virtual currency regarding the various risks that they are undertaking by exposing themselves to these cryptocurrencies. Now we have decided to ring-fence the RBI regulated entities from the risk of dealing with entities associated with virtual currencies. They are required to stop having a business relationship with the entities dealing with virtual currencies forthwith and unwind the existing relationship in a period of 3 months' time. However, we also recognize that the blockchain technology or the distributed ledger technology that lies beneath the virtual currencies has potential benefits for financial inclusion and enhancing the efficiency of the financial system, and we also believe that they should be encouraged to be exploited beneficially for the economy. Staying on the digital currency, in response to the emergence of private digital tokens, all over the world, several central banks are debating the possibility of introducing a fiat digital currency. As opposed to the private digital tokens on which I just spoke about, these are issued by the central bank. They constitute the liability of the central bank, and they will be in circulation in addition to the paper currency that we have. It also holds the promise of reducing the cost of printing of the notes. So, recognizing this, we have constituted an interdepartmental committee in Reserve Bank of India who will produce a report, and they will explore the feasibility and desirability of issuing a digital currency by the central bank, by the Reserve Bank of India, and to guide us in this matter in future. Thank you.
Thank you, Mr. Kanungo. I'll take a few questions. Hindu?
Yeah, and you have also said that the HRA impact will be there till mid 2018. However, at the same time, you have also given an estimate excluding the HRA impact, which has also been highlighted. Can you throw some light on the issue?
Dr. Patra?
If you recall, in the Monetary Policy Report of April 2016, we did a detailed analysis of the 7th Pay Commission and its recommendations. These recommendations are salaries, allowances, and all that. So, of this, the house rent allowance has a bearing on inflation. Remember that housing has a weight of about 9.5% in the CPI, so that what happens is housing matters to the path of inflation. Now, what the CSO does when it measures housing is that while it collects rentals from all over the country, for the government housing, it imputes a house rent, which is the house rent allowance. Now, when we came with the 7th Pay Commission's recommendation, the house rent allowance was increased by 105.6%. So that is what it would impute, but that is not real inflation. It is just a statistical effect which is boosting up CPI. So what we are doing is, just to focus on the real underlying inflation pressures, we exclude house rent allowance from the CPI. So you can see that we have presented those projections and we have underlined them to bring your attention to the fact that when you assess inflation, please exclude the house rent allowance effect because it's purely statistical. So you can see that for the first half, if you exclude housing, the projection comes down by as much as 35 basis points, which is the full measure of the impact of HRA, which started in July and peaked in December and will wane during 2018. That's why the underlining. Thank you.
Because the impact of the HRA on account of the central government wanes, the impact on inflation ex HRA in the second half is not there. So it's because of that in the first half it makes a difference, in the second half it doesn't make a difference. Going forward, as state governments roll out their HRA revisions, we would have to be cognizant that we need to exclude that from the CPI index to gauge the exact amount of inflation. And that first round statistical effect of the HRA revisions from the state governments would also have to be excluded However, if there are second round effects on account of expectations and aggregate demand, those we will take into account. But the pure statistical effect of HRA revisions have to be excluded from the CPI, and we had telegraphed this in April 2016, so it is just to emphasize that fact. We'll take Wall Street Journal.
Thank you, sir. Sir, I would like to know, why have you switched to GDP from GVA? And do you see the economic recovery is strong enough to keep up the momentum if RBI has to raise the rates later?
Request Dr. Acharya to.
Yeah, let me take the question on the switch from GVA to GDP as the headline measure of economic activity. So I think it is mainly to conform to international standards. Globally, the performance of most economies is gauged in terms of gross domestic product or the GDP. This is also the approach followed by multilateral institutions, international analysts and investors. And primarily, they all stick to this norm because it facilitates easy cross-country comparisons. So, and as you know, the CSO has also started using GDP as the main measure of economic activity since Jan 15. So even though there are good economic reasons to employ GVA as the supply side measure of economic activity, we have decided to switch to GDP, but for convenience of everyone, in footnote 2 of the resolution, we have clarified what would have been the imputed GDP growth numbers from the GVA numbers that we had provided in February. So you can see what is changing between the two policies.
Thank you. ABP News.
सर थैंक यू वेरी मच. मेरा सवाल ये है कि जब एक तरफ हम लोग कह रहे हैं कि जो सीपीआई है वो कम रहने का है, हमने देखा कि फरवरी में कम है, मार्च में भी कम रहने का आसार है और नेक्स्ट फिस्कल में भी 3 क्वार्टर में कम रहने का है, तो ऐसे में आपने पॉलिसी स्टैंड न्यूट्रल क्यों रखा है और पॉलिसी रेट को चेंज क्यों नहीं किया?
The inflation prints for February did turn out to be softer than our projection. Much of this is because of the seasonal softening of the prices of vegetables that occurs during the winter months. However, the MPC looks ahead, and we noted that there are several uncertainties around the baseline inflation path, which is why we kept the stance neutral and the rate unchanged. First, there is the uncertainty around the revised formula for MSP as announced in the union budget for Kharif crops, which may have an impact on inflation, although the exact magnitude will only be known in the coming months as the program is rolled out. So that's one uncertainty. Then there could be the risk of some fiscal slippage from the union budget estimates or over the medium term, which could adversely impact the outlook on inflation. There are also risks in this area from slippages at the level of state governments on account of higher committed revenue expenditure. The companies and firms that we poll in the Reserve Bank's Industrial Outlook Survey expect input and output prices to rise going forward. Lastly, the volatility in crude prices has imparted a fair bit of uncertainty to the near-term outlook, and for these reasons, we have continued with the status quo and risks tilted to the upside. We will closely monitor the evolution of these handful of factors and how they impact on inflation, and that underpins the decision that was taken by the MPC today. Business Standard.
Thank you, Governor. Sir, now that you have come up with a firm deadline that after March 1, if an account is NPA, 180 days of resolution, etc. Now banks are saying that it will lead to 600, 700, 900 accounts clubbing into NPA or resolution needed for that. So are you concerned that it will lead to risk aversion of banks to lend? And also the investment pattern of companies will be disrupted.
Thank you. Mr. Vishwanath.
See, one is, the reasons why we have introduced this revised guidelines is basically because we believe that the IBC has given a framework for resolution of stressed assets, and the development that are happening is giving us comfort that will kind of go in the right direction. The second part is that the default definition is 1 day, but NPA definition remains 90 days. So we do not see why this circular by itself should result in more NPAs coming, number one. What we have of course done is that we have withdrawn those schemes which resulted in banks postponing the recognition. And therefore, I don't think we must see it in the light that you are saying.
Thank you. Economic Times.
So good afternoon, Governor. So recently, in one of the public fora, you spoke about the absence of regulatory powers on the PSU banks in how to control them and how to bring order there. So after there have been some instances of reports about some lapses in private sector banks as well. So I'd like to know whether there has been any development from the regulator's point of view on these institutions. Thank you.
Those are two different issues. And they are not related. What was said in the speech and the debate around it relates to the legal powers that the RBI has, which seem to be asymmetric between public sector banks and private sector banks. And therefore, that has got nothing to do with our supervisory and regulatory action on any bank concerned.
So that's the time to... You want to take one more question, sir?
So my question is related to the earlier question. Have you been, talking to the center regarding the regulatory powers of the RBI, whether you can, modify them and act tough on the PSUs?
This requires amendment to the Banking Regulation Act. As the Governor has said, the non-neutrality of RBI's powers comes from the provisions of the BR Act, and that needs to be changed. So the Governor has made the bank's position on this very clear. So there will be discussions on this.
Thank you.
All right, that does look like that's the end of the press meet. That was the RBI's Urjit Patel. They're talking through, I think, some of the points he reiterated, the upside risks to inflation. And I think that's the only question I've left now, Anand, is that they've revised the band for the first half downwards to 4.7 to 5.1%, right, versus the earlier band of 5.1 to 5.6%, right? So that is what the market saw as dovish. You saw bond yields come off to 7.1, 7.2%, below 7.2%. And yet in his commentary, he chose to focus on the upside risks to inflation. Is it just me that seems to think there's a dissonance here, or is it just the food credit bit that has helped them revise the band downwards, but everything else seems to be an upside risk?
I totally agree with you. In fact, the policy seems to be slightly, the policy statement seems to be slightly dovish, but these statements have been more on the hawkish side. I think he has highlighted a lot of risks on the upside, and which we have earlier discussed also, some of the risks being on the fiscal slippage and the crude and commodity prices, the uncertainty there. So some of these risk points or the impact points have really not improved as we see. So I think possibly the markets were in a slightly oversold zone, and possibly they are just trying to cover that gap. I think possibly the band should be in the 715 to 735 zone, and we are clearly at the lower end of the range.
Would you revise your floor? You told me before we went into the policy that your floor for the year was roughly 7.1, 7.2, right? Or 7 to 7.1.
7.7 to 7.1.
Does your floor change right now?
I don't think it should go below 7.1 levels. I don't. So I think the broad range for the year should be between 7 to 7.5, maybe 7.1 to 7.5, and for the timing, I think it should be around 7.15 to 7.35. There are a couple of uncertainties, a couple of factors which we'll have to look at. For example, monsoon, how the monsoon pans out, and how the crude prices and global commodity prices behave. There have been some talks on the trade wars, which actually leads to a softening of commodity
crude,
prices.
The full understanding of
some of these
MSP,
commodity
the trade
prices,
protectionism.
and we would also need to look at how the US, the dollar yields behave.
Sure.
Some of those uncertainties are still there, but I think the broader range should be between 7 and 7.5. And for the timing, I think we should be more comfortable in the 7.15 to 7.35 zone.
All right. I think that sort of wraps it up for us here.
Yeah, just final comments from our other experts before we just wrap it up. I think Ms. Kant is with us as well. And Ms. Kant, you probably got a chance to hear the governor as well. Not too much. I mean, some odd comments on, some side comments on digital currency by the RBI. They spoke about how the switch from GVA to GDP in order to match the international standards. But the only dichotomy, as we've been talking about, is the difference between the policy statement and the clear reference from Dr. Urjit Patel on the upside risks to inflation. Aside of that, we didn't see any kind of divergence between the policy statement and the...
In fact, if I can put it this way, Anshala, it seemed like the policy was talking to you, but Urjit Patel was talking to Anand here in the studio. Because before we went into the policy, Anand was very clear that this policy was going to focus on the upside risks of the to inflation, and you were very clear that it was going to be very benign. Do you see a dissonance in the policy and what it says and the comments coming in from the RBI governor?
Not really, the upside risks the governor mentioned, they are well known to all of us, but then there are, your other people who were on the panel with us, they themselves had said how it is relatively contained, even the HRA, whether there'll be a, it is a, graded impact will come from the different state governments, and the MSP also, some of it will go on to the next year. So, while all those risks are there, or the crude oil prices, but they may not be as much of impact as had been expected. That has been our clear house view for a long time. In fact, our chief economist has been very strongly of the view that the inflation through 2019 will not go beyond 5.25%. And I think we have been validated today by the view of RBI, and we are glad that they have done so, because they have always been over-pitching on the inflation side over the past few months. So I think, this is along good lines. It augurs well, and I think some of the other micro steps they have taken in the past week or so will help the banking system, at least clear the next 2 or 3 quarters. When a bulk of the resolutions are expected to go underway in NCLT. Bond yields have already started coming off, and we expect that they could actually go down further in the coming days. It should help this quarter, pretty much help us in this quarter as well.
All right, Anshala, we'll leave it there. Thank you very much for joining us this afternoon. And Anand, thank you very much for being here in studio. So that's the broad takeaway from the RBI monetary policy, or MPC monetary policy statement this afternoon. A benign outlook on inflation. In fact, if anything, a dovish outlook on inflation, as some might put it there. We saw the reaction play out in the bond market. And in the equity markets, we've seen markets hit the 2% increase almost. Yeah. So at the day's highs after the policy announcement, and the bank nifty, or the Nifty Bank, doing rather well.
Yeah, 2.6%. Actually, let's take off from there. The last 15 minutes of trade left. Anand and Anshala, many thanks for joining in today. Let's just stick to trade for the last 30 minutes of trade. In moments from now, we'll get in Mayuresh Joshi as well to talk about his thoughts. But just look at what's really moving the markets. It's the Nifty Bank, yes, as Menka rightly stated. The PSU banks have really come back with the bang. Pre-policy, they were flattish. The likes of SBI, Bank of Baroda and a few others have really come back with the bang. Look at the strength that the private banks have offered. Kotak Bank is up 4%. I don't remember the last time I saw Kotak Bank showing such a big move. ICICI Bank 3.5%. NBFCs like Bajaj Finance, etc. have really moved up in trade as well. So they continue to do well. But the heavyweight private sector banks are coming back and making their presence felt. I'm told Mayuresh Joshi would be joining us any moments from now. And he'll be with us. But as I said, I don't remember the last time too many of these stocks like Kotak Bank, etc. did so well in trade. Mayuresh Joshi is with us. Mayuresh, full tilt towards the markets, 2.7%. And you could argue that the first 1.5% was because of global cues, but the RBI statement's really giving a further fillip. Do you think this is a bit of a change in the near-term market sentiment? And if so, where does this take us?
So afternoon, Neeraj. Oh yes, I think what statements have been put forth have been taken very, very positively, both in terms of the expectations for the markets in general, but look at the bond markets as well. So the immediate reactions of what you had probably seen a few days back with a lesser borrowing program from the government side, and what you probably looked at in terms of postponement of the Indian AS, which is the accounting standard requirements, along with spreading out of the losses on the bond markets from the bank's books over 4 quarters. I think all this is probably given fillip. And again, I think there was a bank expiry today. So the weekly expiry is where the shorts have also got covered to a large extent on the banking side specifically. So yes, I think a near-term perspective, the markets probably have probably just turned the corner, but the upside risks that the governor was also flagging off still might be there in the system. So yes, from near-term perspective, I think these are good tidings for the markets.
Well, Mayuresh, the inflation band coming off, the yields coming off would naturally lead to some of the PSU banks doing well. I can understand that. But there is, I mean, I'll be very, very interested in also seeing what the cash market volumes are in the session today. This statement alone wouldn't lead you to change your stance on banking stocks per se, would it, Mayuresh? The PSU banks or maybe even the expensive private sector banks, the likes of Kotak or HDFC, all of them are doing well right now.
So they might because of what has been said, but what largely happens in terms of the balance sheet recognition is that you're just going to postpone the entire mess that has got created. The second element, obviously, Neeraj, that remains very, very sticky is the credit growth itself. So I think as the entire concentration is going to be more on recoveries and upgrades as time and again we have been observing, and if this is the case from Q4 results, you might have some stickiness happening in terms of how the entire advances growth specifically on the PSU side will be. I think the entire argument goes on the flip side for the retail private sector banks where the loan growth still will be very, very stupendous because the retail advances are going to remain very, very healthy. So a large element in terms of the skew that gets created in terms of the core parameters in terms of advances growing at a fast clip should probably be seen in the context of retail private sector banks performing exceedingly well. And again, the asset quality pressure is not playing out. So even the valuations might be a little bit on the higher side, the trade-off probably still remains with that. But with yields coming off, Neeraj, I think the interesting aspect, and if these do remain at lower levels because of all what has transpired, will be the NBFC space. Because again, Q4 might be a little bit of a hit in terms of their NIMs or spreads. But if they remain lower, I think the kind of exponential growth that you can probably get, specifically in terms of rural advances and even the urban consumption picking up, that can have a substantial impact in terms of balance sheet dynamics. So a few NBFCs, as we have been preferring, can also stay in the limelight if the yields probably stay at lower levels over the next few weeks.
You know, mind you, yields have stayed low today, despite there not being any mention about the revision to the foreign inflows or the foreign investors' caps on corporate bonds or GSECs as well. So this has happened despite that. If that would have happened or if that will happen at some point of time, then that just gives a bit of a further fillip. That is not to say, I'm not an expert on yields. I don't know whether yields will stay at these levels or no, but just bringing that to the notice. By the way, something's happened. I mean, look at the broader end of the spectrum. I just want to bring up the mid cap and the small cap indices. I don't know if the indices by themselves are moving up. The market bet certainly would have widened from where it was. 2% higher for the mid caps. The small cap index will also come up on your screen. I would guess about 2.3%. And the market breadth, which was anyways very, very strong, the breadth has stayed as it is. Maybe the percentage gains have moved up. Look at VIP Industries, 19%, Future Lifestyle, 12%. And then a clutch of these policy beneficiaries, Canara Bank, Care Ratings, Bank of India, there is a substantial move. Syndicate Bank, BOB, some sharp upticks that have come in to each of these names in the last few minutes of trade. So the broader market strength is quite exemplary. Something's happened with VIP, you don't quite know what, but a 20% move and a sudden spike in the last few minutes of trade. So a strong up move. I would reckon that VIP is now trading close to its life highs. Bring up the 1-year chart of VIP Industries. This is a very strong move. Close to, I'm not saying it is at those highs, but just close to the recent highs that it has clocked in. Yeah, just in or around that. The 12-month about 76%. This would be close to life highs for VIP as well. Mayuresh, what would you buy? A clutch of names pre-policy which were anyways trading at highs. A bunch of mid-sized names have now started to move up. We're seeing some crazy action in stocks like VIP, Future Lifestyle, as I said. What is it that you're going out and buying?
No, so I think we're still following the themes which we believe can have a strong earnings momentum. So infrastructure, within infrastructure, selective road and infrastructure EPC players is something that we will still continue to pursue, because the order wins that you've probably seen come out both from NHA and MORTH are quite spectacular, and they would continue that way. And if the execution patterns remain extremely high, again, the kind of leverage that they can create on the balance sheet remains positive. So I think KNR Construction, Sadbhav, Ashoka, Buildcon, Dilip Buildcon has been an old favorite, but the movement has been too sharp. So I think a clutch of these name on declines in a staggered way is something that we'll continue to like. Cement as a cyclical theme is where our belief is that over the next few quarters you should see significant amount of volume growth pick up. And as utilization levels start picking up, both on the angle of volumes picking up and demand coming back significantly, you can expect utilization levels to be around 80–85%. And that itself creates the kind of push through that is required both in terms of realizations and prop up on the EBITDA margin front. So the return on capital employed and the EV per ton should improve drastically. So names like Ramco Cement, which have been doing very well in this session, is something that I like. JK Cement, JK Lakshmi Cement, which is one of the cheapest stocks, both in terms of valuations and the cost optimization programs that it is doing at this point of time. The third element obviously becomes a few of the IT stroke pharma stocks. So though IT stocks have done exceedingly well, again, if you look at the equation on how the cross-currency movement has been, and expectations of BFS specifically expected to do well over the next few quarters should augur well in terms of both the reported sub-segments, the digital transformational wins, as well as the geographical presence, specifically in terms of outsourcing in the aftermath of what you can probably experience out of Brexit. So European business, US business, BFSI, retail, manufacturing, and all the sub-segments should do well. Utilization levels, attrition levels should far be more better than what you've probably seen. So large caps like HCL, Tech Mahindra obviously remain very, very lucrative. And with the mid-cap space, stocks like Cyient or something even like a Nucleus Software is something that I've been preferring, where the worst in terms of the capex has been done and the intrinsic cash flows should improve here on.
Right.
Within pharma, I think Ipca Labs is something we prefer.
Mayuresh, what about the active boys? Any thoughts on VIP Industries? Up 18% today. I can't fathom a reason why, but it's up 18% today.
I'm not too sure myself. So this is one stock that we've liked in the past. And again, the entire story in terms of having an asset-light model, outsourcing most of its needs from China, our currency remaining extremely stable, a large part of the market, the 9,000 odd crore luggage market being unorganized. And you're probably seeing only 3 players within the organized space that are actually doing well. So VIP, Samsonite, and Safari Industries. So yes, VIP was something that I liked in the past, but at the current juncture, I think Safari Industries, Neeraj, is something that I'll continue to prefer, both in terms of the acquisitions that it has done, the new products that it has got, the deepening of its retailer and dealership network, and again, the balance sheet dynamics. So again, an asset-light model, healthy balance sheet, and earnings expected to remain very, very strong over the next 2 years. So Safari from this pack is something that I'll continue to like, at least at this juncture, considering valuations.
Interesting. The best gain for VIP since a really, really long time. I'm told November 2016 is when they last clocked these gains. So very strong moves there. What else? Future Lifestyle has a 9.5% gain. Praj Industries has moved up 8% higher. So very good going. Surprise, surprise. Fortis Healthcare 7.5% higher. I don't know if I missed a news here in the policy news, but Fortis Healthcare is up about 7.5% higher. So that's doing rather well for itself. And Mayuresh rightly mentioned NBFCs would benefit. I think some of the microfinance names too. Ujjivan Financial is now up 7%. Bharat Financial was trading at life highs, even pre-policy. I don't know if it's strengthened further. No, not quite. Actually, it has 2.9 or 3%, but at 1132, this is trading at new life highs for itself as well. Very, very strong moves. Obviously, there would be some losers, 2 or 3 odd names, the likes of Future Retail, Balrampur, etc. But today is a day for gainers, and the PSU banks in particular doing very, very well. I'm sure there were some trade calls would have been there, and we'll talk about some of those in tomorrow morning show as well. But as we get ready to wind down trade, just trying to point out certain other pockets which might be doing well. By the way, the commodity names, the likes of Vedanta, Hindalco, etc., are really revving up. As we close, they are the top gainers on the Nifty 50. Vedanta up about 6.5%, Hindalco about 6.5%. So these are the top 2 gainers. And then the PSU banks follow, the likes of SBI and some of the others. One last question, Mayuresh, very quickly, which is very close to market close. But just a quick thought on Bajaj Finserv or Bajaj Finance. Very strong moves in the last 3 or 4 sessions. For Bajaj Finance, actually, the last 10 days, it's gained almost 17-18%.
So solid business model, Neeraj, and I think the business model itself is driving the kind of earnings compounding that can be expected from the stock. So consumer durable financing is something that will remain very, very strong for the company in terms of their SME listings itself. They have done a strong identification in terms of the potential for the SMEs that they can market. The NIMs expected to remain extremely strong going ahead as well. The borrowing mix is diversified, and the asset quality pressures should not be as evident. So what you probably had seen in the past in terms of spike up in GNPAs and credit cost should probably peak off over the next quarter or 2, and that itself will give it the impetus to probably grow faster. So yes, maintain a positive view on Bajaj Finance.
Okay, Paresh, thanks for that answer. Just stay on. We'll take a final thought from you, but the market's about to close. And just to show our viewers how we are shutting shop, extremely buoyant trades today on the benchmark indices. Post the market close, we'll also look at what the world markets are doing. But frankly, this has got, the last 1% has got a lot more to do with what we have done in the session today. Nifty Bank 2.7%. I think commodities, so metal names, Hindalco, Vedanta, JSPL, Tata Steel, a clutch of those names have done well. Yesterday's top losers like UPL, etc. too have done extremely well. ICICI Bank about 3.5% up in trade. Hero MotoCorp and Eicher Motors about 3% apiece. Very, very strong gains. Hardly any losers. Cipla is the only sore spot, down about 1.7%. But otherwise, we've had a phenomenal run on the large caps today. Not to forget that the mid caps haven't done too badly. Maybe a shade lower than the Nifty Bank, but still outperforming the Nifty by about 1/3% or thereabouts. Canara Bank, Care, Praj Industries, the list of names remains pretty much the same. Stocks at 52-week highs today include Interglobe Aviation, include Avenue Supermarts, include Shriram Transport Finance, which has really zoomed. Bandhan Bank is trading at new highs for itself. Apollo Tyres and MRF from the tire space have done really well for themselves as well. And IndusInd Bank, with a 2.5% uptick, in addition to Bharat Financial, both of them would tend to move in tandem, are trading at new highs for themselves. SRF at 2027 is up about 1.5%, trading at new highs as well. Nestle India 8400, minor gains but trading at new highs. But it's not really about the defensives today. It's got all to do with the high beta financial names, rate sensitives, which have done really well. Real estate quite hasn't participated. Autos probably did their bit yesterday. Today's been all about banks, even from this rate sensitive basket. Mayuresh, final 2 or 3 questions really. We started off saying, asking you this about whether or not this policy, whether it changes the near-term sentiment or not. That is one thing. Just looking at the statements that came in from the governor as well as what is there in the press release as well, or in the release as well, there ample mention of the global growth and the local growth. The nascent recovery words have gone away, and what's come in is GDP growth, which will look very high, which will look very good, and high frequency indicators indicating growth momentum on the rise. It's a very buoyant growth outlook comment that has come in from the Reserve Bank of India.
No, it has. And again, I think if you look at the high frequency indicators, and I was incidentally looking at the data a few days back, there is evidence of green shoots emanating from most subsegments within those data points. Even globally, as you're probably looking at things stand out, I think the markets have gestated to a large bit recovery in a lot of corporates showing steady numbers. Now in the Indian context specifically, Neeraj, I think what happens with corporate earnings beginning this quarter is going to be a very key pertinent feature. So if you're able to probably build on in terms of what we reported in Q3 and then justify the exact, I think, the arguments that one has for a 14-15% compounded growth, though the caveat might be a few PSU banks might still struggle. So I think ex-PSU banks, if you're able to probably grow at a faster clip, I think that should give the much relief that the markets want. The initial reports for monsoons have also been very, very encouraging, and the geographical distribution of monsoons is going to be extremely crucial in terms of the consumption patterns that one really harps about and one really remains bullish about from an analyst or a market perspective. The outside risks, obviously, as the governor was pointing out, and as market participants also anticipate, would be movement in crude. So if crude stays above $70 a barrel, I think that does pose an outside risk, both to our current and trade deficits as well as our fiscal deficit. And again, I think the inflation numbers might have an upside risk anywhere between 0.3 to 0.5. What also happens in terms of yield movement for any of the factors probably turning worse off because rain's not coming through on the domestic side, the fiscal deficit targets with the lower borrowing probably being pushed to the second half, having an impact thereof, can again have some amount of SAR effects in terms of the overall yield movement. And the third element again is if corporate earnings generally do not climb up or they disappoint. So yes, I think there are some outside risks, but the general frequency indicators from a macro standpoint, as well as what has come out from the policy, does give positive sentiments, and the buoyancy in the markets can get reflected in a positive manner over the next few days and weeks.
Mahesh, if somebody wants to put money into one large cap bank, would you choose the expensive names? Would you choose the one or two names that have stood the test of time but have had some temporary have had some hiccups? Let me not use the term temporary or permanent. Or would you use or would you invest in one or two of the large public sector banks if you had money to just choose one bank?
So I think that's a very difficult question to answer, but yes, if I have to choose one, my entire sense is that Yes Bank is something that I'll still be very, very optimistic about. It's not that I don't like the larger retail private banks or something like State Bank within the PSU universe. But Yes Bank, in my opinion, has delivered an exceptional performance. So if you leave aside the last 2 quarters, both in terms of higher reported GNPAs, the divergence that it had to provide for in terms of elevated provisioning and the elevated credit costs. Again, I think that is largely getting built in terms of how the bank's performance will be going forward. So I think the GNPA should slowly start coming down. What you're probably seeing in terms of the provisioning coverage ratios, that should start moving up, which again is a very, very healthy sign, because higher the PCR, I think you're probably alleviating a lot of risks that can emanate from a lot of assets that you probably lend to. The third angle obviously becomes the capital adequacy, and they have enough capital at least for a year to probably have the 25-30% advances growth, and very, very confident in terms of maintaining their NIMs. So all the parameters that went on the wrong side of the last 2 quarters should start course correcting, and in the next few quarters you should probably see steady advances growth, which is better than industry, NIMs being stable, asset quality being stable, credit costs coming down, PCR improving, cost income ratios coming down. I can't ask for more, and valuations are not too demanding. So yes, Bank.
Okay. Mahesh, we'll leave it at that. Really appreciate you taking the time out and joining us, even though you were told on a last-minute basis. But thank you so much for being with us today on Bloomberg Quint. Appreciate it. Okay, with that, it's a wrap on this edition of Countdown. But up next, we get you a complete wrap of the day's trade and some strategies to watch out for tomorrow on our market wrap. Rahul Shah of Motilal Oswal would be joining us on the other side of this break. Stay tuned.